Good morning and welcome to the Killik & Co market update. Markets have continued to react well to those low inflation numbers that we had last week from both the UK and the US. And as a result, the S&P 500 is within touching distance of that record high that it hit in January 2022. Here's the 5-year chart. The record high was 4797 and it's currently at 4557. However, it's worth noting that the gains of the index are really just due to 7 stocks, known as the Magnificent Seven: NVIDIA, Amazon, Alphabet, Tesla, Microsoft, Meta, and Apple. If those 7 stocks were removed from the index, then the performance would be very different indeed. On this chart, the orange line shows the performance of the regular S&P 500 index from the start of January this year to the end of October this year. It's up just over 9%. The green line shows the performance of the Magnificent Seven, up over 50%. The red line is probably the most interesting. It shows the performance of the S&P 500 without those 7 stocks. On here it's called the S&P 493, and it was actually in negative territory over this time period. So this really demonstrates the difficulty of choosing an appropriate benchmark for your portfolio. If you don't hold the Magnificent Seven, then is the S&P 500 really a suitable benchmark for your equity portfolio? This week we had results from NVIDIA, a leading semiconductor company and a member of the Magnificent Seven. NVIDIA has designed the chips that are used to train ChatGPT. The results were ahead of expectations, and the company remains the best performer in the S&P 500 over the last year. Here's the share price chart over the last 5 years. You can see the shares have gone from below $40 to nearly $500. Many might look at this chart and think the shares must now be expensive because the share price has come up by so much. But it's also worth looking at the price to earnings ratio, which is another way of measuring how expensive a share is. The price to earnings ratio compares the price of a share to the level of earnings or profits that the company is making. If the share price is going up but the earnings are going up as well, then the shares might not necessarily be becoming more expensive. Here's the price to earnings ratios for NVIDIA over the last few years since the start of 2019. The pink bars highlight times when the price to earnings ratio was at a similar level to where it is now. If I go back to this share price chart, that pink circle highlights a time when the price to earnings ratio was very similar to its current level, despite the fact that the share price has come up so much. And finally, there's been some drama this week with Microsoft. Microsoft has invested $13 billion into OpenAI, which is the owner of ChatGPT, and Microsoft now owns about 49% of the company. It's thought that OpenAI is worth about $80 billion, so this has already been a profitable investment for Microsoft, and there's a lot of excitement about what the future might hold for OpenAI. Last weekend, it was reported that the board of OpenAI had unexpectedly and suddenly fired the chief executive, Sam Altman. During the week, the majority of employees at OpenAI signed a petition to get the board fired and to get Sam Altman reinstated. Microsoft stepped in and offered Sam Altman a job, and they also offered jobs to all of the employees at OpenAI. In the end, the board did step down and Sam Altman was reinstated, but Microsoft was considered to have played this very well. Sam Altman and his team at OpenAI are clear leaders in the field of artificial intelligence, and Microsoft have ensured they will remain connected with him and the team, either by their stake in ChatGPT or by employing them directly. This week, the shares of Microsoft hit a new record high, as you can see by the chart here. Moving on to have a look at next week, we have got results due out from Intuit and Salesforce. Also this week, we have recorded a separate video with some of our thoughts from the autumn statement. That's it from us. Have a great weekend, and we'll see you next Friday.